1968 should have been the greatest year in Wall Street history. The post-war economic engine was screaming at full throttle. The American middle-class teachers, plumbers, and veterans had finally discovered the stock market. For the first time, investing wasn't just for the elite. It was for everyone. Trading volume was soaring, profits were at record highs, and the future looked golden. But behind the mahogany doors of the world's most powerful banks, there was a secret. A terrifying, silent crisis was unfolding. It wasn't a crash. It wasn't a scandal. It was paper. Wall Street was drowning in its own success. While the traders on the floor were making millions in seconds, the back office was still operating in the 19th century. Every single trade required physical stock certificates to be moved by hand across Lower Manhattan. By the summer of 1968, the system didn't just slow down, it stopped. Stocks worth billions were simply missing. Checks were being found in garbage bins. And to save the global economy from a total meltdown, the New York Stock Exchange did something it hadn't done since the Great War. They shut the doors. To understand how this happened, you have to understand the physical reality of a trade in 1967. Today, you press a button on a smartphone app. It's digital, invisible, and instant. But back then, a share was a physical piece of paper, an ornate, engraved certificate that represented your ownership in a company. These were not just receipts, they were the assets themselves. When you bought 100 shares of General Motors or a TNT, someone had to physically find that specific certificate in a vault, verify the signatures, stamp it, and send it to your broker. This was the domain of the runners. Thousands of young men, often just out of high school, sprinting through the narrow, wind-swept alleys of Wall Street. They carried heavy leather bags filled with millions of dollars in physical paper, dodging traffic and pedestrians to deliver certificates from one bank to another. This manual system worked perfectly when the market traded 3 million shares a day. But as the 1960s roared on, the volume hit 12 million, then 15 million. The machinery of the market began to grind against itself. The back office, the dimly lit basements where the clerks worked, became a war zone. These rooms were filled with the deafening clatter of typewriters and the smell of stale coffee and ink. Clerks were working 15-hour days, 7 days a week, trying to log a mountain of paper that never stopped growing. The turnover rate was nearly 100% because the stress was unbearable. People were quitting mid-shift, leaving piles of unrecorded trades on their desks. It was a paperwork blizzard. Brokers were literally losing track of who owned what. For the first time in history, Wall Street realized that power wasn't just about having the most money, it was about having the most efficient machine. By June 1968, the situation turned from a headache into a national catastrophe. The fail-to-deliver rate, the number of trades that simply didn't happen because the paper was lost, hit $4 billion. In 1960s money, that was an astronomical sum, enough to bankrupt the entire financial industry. The New York Stock Exchange governors gathered for an emergency session. The atmosphere was panicked. They knew that if the public realized how broken the system was, there would be a run on the banks. Their solution was desperate and humiliating. They decided to close the market every single Wednesday. Imagine that today. Imagine if the NASDAQ or the New York Stock Exchange just decided to turn off every Wednesday because they could unkeep up with the typing. It was a staggering admission of failure. The financial capital of the world was broken. During these dark Wednesdays, the streets of the financial district looked like a ghost town, except for the windows of the back offices, which stayed lit all night long. Clerks were literally sleeping under their desks on piles of mailbags surrounded by mountains of certificates. This was the Great Reset of the 1960s. The industry was terrified that if a panic hit, the entire concept of private property on Wall Street would vanish because the records were in shambles. As the crisis deepened, the human cost became clear. Prominent firms that had stood for decades began to wobble. Giants like McDonnell and Company and Hayden, Stone were suddenly facing insolvency. Why? Because they had fails in the millions. They owed stocks they couldn't find and money they couldn't track. The chaos even forced the government to step in, leading to the creation of the Securities Investor Protection Corporation, or SIPC, to protect investors from brokerage failures. This era proved that Wall Street was no longer a place of gentlemen's agreements and handshakes. It was a high-volume industry that required industrial-strength solutions. Out of this chaos, a new power was born. The crisis proved that the old boys club, the men who relied on physical paper, was obsolete. Wall Street needed a savior, and it found one in the most unlikely place, the computer. This was the birth of the DTCC, the Depository Trust and Clearing Corporation. The industry realized they had to immobilize the paper. They created a central vault where all certificates would stay. And instead of moving the paper, they would just change the numbers in a computer database. This was the true beginning of the modern era. But this transition wasn't easy. The old guard resisted. They didn't trust the flickering green screens of the early IBM mainframes. They didn't want to give up their engraved certificates for digital digits, but they had no choice. The paper had defeated them. However, this progress came with a heavy price. Small, historic firms that couldn't afford the multi-million-dollar mainframe computers began to collapse. Over 100 brokerage firms vanished or were forced into shotgun marriages with bigger banks. This was the moment Wall Street consolidated. The power moved from the individual broker to the massive computerized institution. The era of the quant and the algorithm was being born in the ruins of the paperwork crisis. By the time the 1970s arrived, the physical stock certificate was becoming a relic of the past. The paperwork blizzard had been settled, but it changed the DNA of finance forever. It proved that in the world of money, speed is nothing without infrastructure. Today, we think we are safe. We trade in milliseconds on our phones. We have blockchain, artificial intelligence, and instant settlement systems. We look back at 1968 and laugh at the idea of men running through streets with bags of paper. But the lesson of the 1960s paperwork crisis is a haunting one. The system is only as strong as its foundation. In 1968, they were overwhelmed by paper. Today, are we being overwhelmed by data? In a world where trillions of dollars move through black box algorithms and high-frequency trading platforms, are we just one digital blizzard away from another Wednesday shutdown? Is our modern infrastructure truly ready for the next surge in volume? Or are we just as vulnerable as the clerks in those 1960s basements? Wall Street is a story of money and power, but it is also a story of the machines we build to control them. And as history shows us, sometimes the machines win, and sometimes they break under the weight of our own ambition. If you want to understand the invisible forces that built the modern market, you need to know the history of the moments when it almost fell apart. This crisis was the bridge between the old world of physical wealth and the new world of digital power. In our next video, we enter the 1970s, a decade of crushing inflation and gas lines. The birth of the vulture capitalists and corporate raiders who changed the rules of the game forever. We will see how Wall Street learned to profit even when the world seemed to be falling apart. Subscribe to Money and Power, Wall Street, and hit the bell icon so you don't miss our deep dive into the decade that invented modern corporate warfare.